It's William O'Donnell, RBS Securities, with us here as we talk fixed income. The mystery of the bond market. Did you ever think we would see lower yields here? Wasn't it a consensus call for higher yields?
Oh, it's been a consensus call for a long time, ever since the big backup that we had in Treasury rates starting in really after QE2 was announced in early November. You know, Treasury rates rose sharply all through November, all into December. We had great economic growth spilling it from the end of 2010 and into 2011. And it's been quite fashionable, actually, to be bearish on bonds and talking about how great the economy is looking and 4% growth as far as the eye can see. But, of course, all that's being questioned recently and especially today.
Let's bring up the research note this morning from William O'Donnell. We're left with a Treasury market that is sitting at highly unstable yield levels and where prices are likely to, I love this, it's so scientific, flap in the breezes of every single Tier 1 data print. How are they going to flap in the breeze tomorrow morning at 8:30?
Well, that's a big question. And what's very interesting about tomorrow's non-farm payroll number, and this is just a gut feel, just over the last maybe I would even say 5 to 6 months, we've had, of course, the Bloomberg consensus for non-farm payroll, but for some particular reason, investors always have been saying, I am sure at some point, and probably this month, we're going to see that 400 to 500,000 print that we typically see in a recovery. Of course, we've never gotten it. And now that the Treasury market's rallying and yields have fallen in the last 3.5 weeks in 10 years from 360 down to around 315, 320, right. You know, everybody's starting to question growth, and now with the consensus around plus 180, people are thinking it could actually be weaker than that. So it's very funny, this psychological game, all in the context of a big trading range in Treasury yields, which is why we think Treasury yields are very unstable here and subject to the whim of all of the economic data.
Where should yield investors be if we are so unstable?
Well, I think the safest place for people to be, and actually it's where we see a lot of central bank inflows, especially in recent days, is in the 3.5 to 4 year sector of the curve. It seems quite likely after Bernanke's press conference that the Fed is going to remain on hold for an extended period of time. And at the same time, it's sort of the sweet spot of the Treasury curve where you get slope and roll down and carry, as we say. In strategy parlance, it's just a safe place to be without getting a reasonable amount of yield without taking on too much duration risk.
Let's look at some history and go cross asset here with William O'Donnell. Bring up elegant chart 1 if you would. And this is one we've shown many, many times. It's the Volcker chart from 1979 and that regression across a 10-year yield and how we're so much in track. O'Donnell doubts a lower 10-year yield is how he labeled it. And I made this chart, Bill, before we saw the commodity carnage today. When you see commodities slammed like they are today, or that euro drop off the Trichet press conference, what does that signal to a bond guy?
You know what that signals to a bond guy like me? That signals that there were excessive positioning and sentiment in those commodities. I like to look at sentiment and position surveys to give an idea of where the asymmetry or symmetry of risk is. And just our survey data has shown that people are very bullish on currencies like the Swiss franc, very bearish on the dollar, very bullish about gold, very bullish on silver, and excessive levels historically. And what that tells you is it's hard to find marginal buyers of metals and grains and very hard to find marginal sellers of the dollar. And you get just a little bit of good news for the dollar out of Europe today, and you see the kind of explosion that we're seeing in metals and FX like we've seen this morning.
Why are the equity markets so removed then? I mean, Barry Ritholtz says the equity markets are separate with their earnings power from so much else going on. Do you agree with that?
Well, first of all, if you look at corporate balance sheets rather than the federal balance sheet or household balance sheet, corporate balance sheets are pristine. And according to our equity strategists, we've got earnings beats this earnings season so far coming along at about 75 or 80%.
Amazing.
So it's an earnings train that's really hard to ignore, and I think that's what's helping to keep equities up when other risk assets seem to be cratering this morning.
Let's switch to the deficit, bring up this op-ed. Martin Feldstein on the show recently sat right next to me and said we need a cap on how much we can deduct, raise taxes, but not tax rates. I love that idea. So simple. Federal revenue must be raised to deal with our very serious fiscal problems, but it would be far better to do so by capping tax rates. Martin Feldstein, how are we going to get this budget straightened out, or are the markets removed from the budget debate?
Truth be told, Tom, I think that's the primary focus of the market going forward over the next 3 to 6 months. We've now learned from recent data from the Fed that tax receipts have come in, especially withheld tax receipts or non-withheld tax receipts, have come in better than expected. That gives Treasury a little bit more time before the real stops are hit on the debt ceiling debate, which is early August. So that's what the market is focusing on. It's what's going to happen. Are we going to get a down payment on the deficit cut in the context of this debate over the passage of the debt ceiling, which we do expect will happen? And I think that's what's going to be the focus of the Treasury market. One reason why Treasury yields have come lower, because as they look forward, they see QE2 ending, they see the effects of the payroll tax cut waning as we go, and of course the waning effects of the big stimulus program, the $850 billion gorilla that's starting to fade as well. And as they look forward, they see less fiscal stimulus and more fiscal austerity. And I think people are starting to worry about the prospects for second quarter and second half growth.
Bill, let's switch gears once more. Muni bonds. Here's the chart, folks. Still elevated muni bond redemptions. You can see over on the right side of the volatile chart how it's higher. That's money coming out of municipal bond funds. Bill O'Donnell, you're a bond guy. Have you ever seen such value in munis?
You know what? I don't pay that much attention to the muni market. In fact, we don't trade munis, but I read a lot on Bloomberg about the muni market, and I thought it was very interesting that some of the muni valuations, at least according to Bloomberg News, are some of the best seen in 5 or 6 weeks, if I read the article correctly this morning. So there does seem to be some money flowing back into the muni market, and truth be told, I'm not that surprised to see it, because as a Treasury guy and a bond guy generally, what I do see in my bond market is that people are looking for rate, they're looking for opportunity, and they're, at least for the last 3 or 4 or 5 months, they've been leaving the Treasury market trying to find yield. And given how cheap munis have gotten in the context of all these redemptions, I'm not at all surprised that money is starting to flow back into munis, given some of the valuations that we've had.
Bill, thanks so much. Bill O'Donnell with us from RBS Securities. Nice overview there of bonds as we go to tomorrow's jobs report.